Hi all, as a part of the OCEN Open House series, today I would like to welcome Bhavik Vasa, who's the founder of GetVantage. We're going to have a conversation with him about OCEN and his journey with MSME lending. GetVantage is only focused on MSME lending. This is what makes this conversation very, very special. Without wasting much time, I'd probably leave it to Bhavik to introduce himself and talk a little bit more about himself and GetVantage.
Sure. Sagar, thank you. Thank you. It's lovely to sit down and have this conversation. And as you and me spoke, we'll try and keep it very candid. Uh, I think a lot of things are happening in the financial services space around us. And I think so timely that we start and kickstart this new year of 2024, talking specifically around what these inflection points are going to be around small business financing, around what the role of networks like OCEN will play. And I think through all of this is where our journey at GetVantage truly started. Over the last few years, we built ourselves tech first and a platform first play to really try and understand that if businesses around are evolving and getting that much more digital, can we make sure that financing also for these businesses can be done in that much more digital, paperless, and a new age fashion? And that truly is what we believe stands for GetVantage, the unfair advantage and growth capital for every small business out there.
Interesting. So, as I understand, this is your second startup, and you've been in the BFSI space, predominantly in the payment space before you entered in the lending space, and you've had quite a stint there. If you were to look at it from a entire industry perspective, what do you think? If there are any parallels, what do you think could be a catalyst in going ahead? What is your experience? I mean, as a neutral person.
Sure. No, so I think, fortunately or unfortunately, I've spent more than 15, 16 years now in the world of FinTech. Even before it was this buzzword called FinTech, it didn't exist. And I think I am lucky enough to have had a global experience, having started my career in financial services in the US, in Silicon Valley, to then having seen multiple cycles of that same evolution across and what technology has done in financial services space, even in India over the last decade. And I think my, one single biggest takeaway, Sagar, honestly, is that financial services and the role of technology being an enabler in financial services truly happens when we are able to kind of bring in a standardization across various players in the ecosystem. I think we've seen this through the evolution of technology, taking us back to the dot-com era, right? We very, very strongly forget that TCP/IP was the first standardization of protocol. And that really disrupted or changed the way internet had to happen for all of us. And I think even in financial services, when technology plays this role of being an enabler, we need to see that same interoperability across various networks, across various stakeholders, and across various ecosystem players. And I think we've seen that through my large journey over a decade building and scaling ItsCash. We saw identification and KYC becoming that much more standardized. We were then able to see a big role of interoperable networks in payments and money transfer. And I think it's only when these interoperable protocols really come into the forefront and pushes the boundaries and the limits for every player and stakeholder in the ecosystem to act is when we start seeing the inflection points happening in that ecosystem. And I strongly believe that what we've seen happen in so many other sectors of financial services, whether it be payments, whether it be trading and capital markets, that's bound to happen now in the world of financing and credit. And I think that's what we all are betting for this next decade, because the importance of these interoperable networks is that they trigger a network effect and allow this very large gap of credit in small business and MSMEs to really explode. We've not even penetrated beyond 10-15% of the actual requirement and need. To share with you a data point, we did an industry first research report with Redseer, which spoke about what the gap of this MSME credit is. As an economy, we want to grow from a 3 trillion economy to a 5 to a 7 trillion economy in this decade coming. But to be able to fuel that growth, the biggest gap is going to be need of this 5 billion plus credit requirement to fuel this growth and to be able to truly meet the potential of the India growth story. And that's going to truly happen with not only what technology can do, but the ability for these interoperable networks to really play a strong role in getting all the ecosystem and players come in the forefront.
I'll tell you how we think of it. So one is obviously interoperability and standardization. Standardization brings in the costs down.
Sure.
Right? Costs down for in terms of integration, in terms of time, in terms of making it very frictionless for people to just talk one language. And it doesn't have to be that everyone talks one language. There will be obviously proprietary players continuing to do what they've built over years. But it's just one more plug that they will probably have within their ecosystem and systems, right? The data, we've best of class data from GST system and everything that has been there. I mean, it's a well-established fact that we have very high quality data available. But for MSME financing to really pick up, the cost and the friction of how people deal with each other has to come down.
Of course.
That's one big reason why we've standardized the protocols. We've introduced the product registry. We've introduced product networks where practically you could just create a product, integrate with multiple people. Hopefully in coming years, we will see discovery happen via the portal where people are doing these relationships right now. We don't mean to change the way businesses happen in the sense that it becomes open where it just flies around to everyone. We do understand that businesses will have relationships. They will talk to each other. They will establish trust between them and they'll do it. But this is a very less, I would say it's a easier way to discover, build these relationships and get talking to each other rather than having to talk 6 months before you enter into a relationship is what we hope that will bring to the table.
And as private players, as industry players, this is music to our ears because truly any change or any disruptive change that happens in an industry starts from public policy or public infra. And I think that's what's really very, very enthusiastic to see the kind of OCEN 4.0 version and the wave. And actually, it makes me push a question over to you and to really share and understand that, the protocols of OCEN is not something that's built overnight. This has been in the works for a long time. What have you seen really as a transformative change between the last versions to now what these versions of the standard protocol is?
Yes, it's not built overnight and it's not built by a single person. There have been an army of people who've been volunteering to get this working. Everyone with a different perspective, everyone with a different thought that's come and contributed to the whole OCEN and where we are right now, right? What I have seen is that we started with a basic fact and it's grown from a gem to a GST where we distributed the protocol over a Word doc to early adopters and doing that to the 4.0 version where we actually standardized it such that any other product can be integrated in a seamless way. We introduced roles. Obviously, all the learnings that have gone through the previous pilots and working and integration have been introduced to the 4.0 protocol. And what I see is that when we talk to lenders predominantly, right, is that once you integrate the inward plug to your loan management system or your systems, whatever is the digital LOS or whatever is the system, whatever approach you take, and everyone has a different architecture, it's easy to work with other products. The delta of adding one more product is very less. This is what will give ability to having a very small pool of borrowers, people with a very small pool of borrowers, but interesting products, very less riskier products. And we hope more lenders will work in traditional ways where people used to go and approach big lenders. You would pretty much be asked how much how much of volume do you have, and all of it. Where we hope if the plug is built to a lender, there will be more experimentation, there will be more openness to work with things,
Yeah.
because it saves a lot of time. The delta to add a product is not very difficult. At the same time, we also feel there is a lot of coverage in MSMEs. I mean, whatever coverage there is there, it's majorly driven towards capex and
Yeah.
not opex, right?
Yeah.
So OCEN
Yeah.
is kind of working towards solving the working capital problem for
Yes.
the MSMEs.
Yes.
I believe one of the major missions of GetVantage was to
Yes.
solve this problem,
Yes.
and this
Yes.
is what makes this conversation very special.
Absolutely.
So
Absolutely.
I'd like to hear from you what has been your learnings, what is your thought process around this, and yeah.
No, you're absolutely right, Sagar. I think the importance of operating expenses for a business versus its need for longer term debt for capex expenses, right? I think there's need for all, but if we can actually truly believe that what technology can do is in a much more seamless and frictionless fashion, be able to have all of these small businesses have access to that short-term capital, that working capital, to boost their revenues from X to Y, to meet their seasonal expenses. And you know, you asked me at the top of this, what is that mission and passion at GetVantage? Why focus only on MSME? And I strongly want to be able to highlight the fact that we are a nation of small businesses. We've always been, right? It's small businesses are the backbone of the Indian economy or any emerging economy. And I think in comparison to being able to just fuel consumption lending, if you can truly be able to have business lending be fueled by this much more tech driven and much more frictionless way of providing working capital, you can start seeing that it's actually this businesses that can grow from X to Y can increase their revenues by just being able to fuel those short term working capital requirements that they have, right? It tends to start fueling the cycle of the entire economy. It tends to boost larger consumption. And I think there in it lies the need for saying India has to be looked at a very different market than anywhere else in the world. And I think we have a lot of traditional lenders who've been able to do a flora of collateral driven capital. There is already enough work that has been done in securitized or this preconceived notion of secured lending, right? Loan against property, machinery loan. That I think already has been solved for by large banks, public sector banks, large wholesale lenders. But what misses out on is that in the absence of this perceived collateral, can we really provide credit and capital to these small businesses without this physical collateral? And I think that's what we've been able to solve with technology. Saying, if I can have real time access to data of these businesses, if I can have real time monitoring of the performance of these businesses, and make sure that the repayments and there is collections control towards receivables, I've actually really changed the notion of what collateral needs to be doing.
That's a very interesting thing that you bring up, and one of the major things that we believe, and I've been at the cost of being repetitive, I'll say it again, is that from the 50 odd financial products, we are going to see more fine grained financial products working towards more, bending towards more transaction,
Yes.
very specific industries, very
Yes.
specific cohorts, whether it's by a digital proximity where something like a
Yeah.
gem portal brings all the gem audience together, MSMEs on gem together, or a GST, which is GST paying MSMEs together, and you can be part of both cohorts, and where you
Yes.
could get better
Yes.
offers, or looking at a ecosystem where you have a bunch of restaurants or an online brand. Their requirements are very different. Understanding those,
Of course.
understanding their data, which
Yeah.
is enabled anyways.
Yeah.
We've just standardizing the way it is coming. I know you've been having a bunch of interesting products that you've been doing. Any particular product and a success story associated with it, where you've been able to uplift a brand
Sure.
to back your statements in the
Sure.
past, if you could put it.
Sure. We strongly believe it's also time to debunk a few myths that have been around for a long time, right? I think there is a lot of negative connotation related with the word debt, firstly. As we already discussed, debt does not only mean long-term, 3-year, 5-year debt. Debt can come in many shapes and forms. And for businesses and founders to understand that there is short-term capital, there is working capital that actually just helps you grow from A to B. To then even disrupting this whole traditional notion around the usage of word lending. I think the industry needs to move from the service provider's lens to more what we call as the service user's lens, right? Let's go to the borrower's lens, right? Let's go to the business lens. And he's actually fundraising. You know, we've gone through this traditional notion that as a bank or as a NBFC, I am lending, so that's business of lending. It's actually fundraising and financing for a business to get access to capital. And I think when we start demystifying a lot of these myths, we are able to come up to the importance of saying why we truly believe that a lot of small businesses can now have access to this capital, have access to this in a much more tech-driven fashion, because a lot of their businesses and how they do businesses is gone data first. So as GetVantage, we simply say that we're born out of a mission and passion. Our platform and tech-first play has really gone about saying, let's understand the requirement of these businesses and borrowers and build products for that. They need capital for managing their cash flows better. They need capital for their revenues better. That's where we innovated with product types of cash flow-based funding, of merchant cash advance, of revenue-based financing. And this is literally those product types that I'm able to now access live data points and multiple data points. And the beauty of this is how can you evaluate a small business more in real time with a triangulation of data, right? What we've seen happen in the last few years is we have now small businesses filing for their GST. We have access to their bank statements and ability to understand the bank credits and understand their cash flows. But the most important is, can you triangulate with an alternative source of data, right? One more source of data, whether they are selling on marketplaces, whether they are selling as online sellers, or whether some streams of their revenues is coming that much more digital. And now if you can triangulate these 3-4 data points, you truly get the health of that small business to now what we call as being able to offer them a unique set of more personalized financial products, right? Can I give this business a very short-term 6-month, 8-month revenue-based funding? Can I give this business capital that's only for that one stream of growth, right? And like you rightly said, every sector is different. The restaurant or the F&B or the retail segment might need capital very differently as a small business, while an online seller might need capital for seasonal times, for spike in growth. But mostly, what a lot of these businesses across the spectrum need capital for either their inventory, their raw material, or for the increase of marketing, right? And that's where being able to create what we call as more personalized capital, where the repayments are also not attached to that traditional way of once a month EMI. You know, मैं बहुत founders से बात करता हूँ, and what we start understanding is that it's really much more tougher for a small business to pay that once a month EMI, क्योंकि वही end of month में I have to pay my salaries, rent payment आता है, all my administrative expenses come, and that's when my EMI also hits. But if I'm able to let these businesses pay back as a small percentage of their daily, weekly revenues, right? It's in such a disciplined fashion that they are able to repay from their cash flows rather than having to now again design their and manage their cash flows better for that once a month repayments. And I think it's this innovation around the platform and tech to evaluate businesses, the different more personalized product types that you're able to offer, and align yourselves and personalize the repayments towards how the business can really afford to repay, leads to some of these great, brilliant success stories, Sagar, that we've been able to see, where we've understood that whether it's a small business from beyond the metro towns and cities, right, from the tier 2 towns, or whether it's a manufacturer in as far as West Bengal, or it's a Ayurveda brand setting itself up from Raipur, and you starting to see that all of these small businesses, what they really needed capital was for quickly procuring some of their raw materials because they already had their orders and their revenue patterns in play. But what they needed is this, they really didn't need 24 months or 36 months of a loan or capital. That's where a traditional lender starts looking at a business and evaluating for a 3-year tenure or 2-year tenure. But if you start evaluating these businesses for a shorter tenure of 6 months, 8 months, and let them rebuild their repayment cycle, you're able to now really bring a new to credit business and a new to credit customer without having to put the lens of these traditional parameters of credit and underwriting.
So I'll just before you jump into the success story, I'll jump in here, right? You mentioned about personalization. You mentioned about giving a very different offer versus a traditional once a month or once a week or fixed tenure or a fixed interval things. You also mentioned saying that most of these businesses have been able to reach a particular point where they want to actually grow to the next level or meet seasonal demands where there is a spike in the regular revenues that they have to be able to take benefit of those seasonal patterns where they see in their business, right? So with OCEN, one of the things that we feel and we've deliberated on this and we've kind of built is the ability to give multiple one-time offers.
Yes.
On the same product, on the same application.
Sure.
15% for 3 months, X percentage coverage, 18% for a shorter tenor.
Yeah. Yeah.
12% for a longer tenor.
Sure.
And let the business decide what is better for them, how they want to repay, and giving the lender an ability to give multiple, as long as you have the engines at your end, which I feel is going to be a big differentiator for lenders going forward, who have more understanding of these businesses digitally. The more they build it, the better they will be able to customize and service, which will be an edge for most lenders. Any particular product that you want to take in as example, explaining through the transaction and the beneficiary, which is the end borrower. Obviously you are making money and that's why you are in this business, but the beneficiary, how it has helped them ride the seasonal wave or particularly grow. I know you work with a lot of brands, and any particular example with a specific transaction where the entire transaction, if you could just dive a little deeper into it.
Sure. And I think what you've touched upon is the importance of truly building a platform, and a network effect clicks in. On one side, you have multiple different types of businesses that want different type of capital. And on the other side, we call it the supply side, right? Making sure that there are enough and plenty lenders or institutions and banks, NBFCs, being able to provide different product offerings, right, with different tenures. And I'll tell you 2 particular examples. And to understand a small business, you have to first understand in what business they are, right? And a product business is very different from a services business, and their needs for capital are very different, right? And a lot of these emerging consumer brands, new age businesses, like you rightly pointed out, most of them really need capital for either just being able to quickly bulk up on inventory or be able to increase their marketing, right? It's one of the two where they need just purely an 8-month or a 12-month tenure. They don't need, this is not for a long-term investment where they need money for beyond 12 months, right? They need for a quarter or 2 quarters, they want to bulk up on inventory as a product company. And so you want to be able to make sure that you have your inventory in place. And then season time kicks in. So you now are going to spend for the next 3 months on increasing your digital marketing or increasing your marketing spends to get the revenues growth. And to be able to structure a very, very simple revenue-based financing model for them, which is a 4-month, 6-month, 8-month tenure product, and where they are pretty much repaying as their sales and their revenues kick in, right? Giving them this with not only different options of interest rate models, but also being able to make sure that their cost of borrowing this debt is one flat fee, right? So I as a business now know that my cost of borrowing this X is Y, and that's it, right? So if my cost is fixed, now as a business, I can plan better and say, is it coming out from my operating margin or my revenues? And if it's coming out from my margin, I'm actually now just that much more clearer that I'm paying a fixed quantum to get access to an X amount of revenue, and can my future cash flows just simply repay that back. On the flip side, if you're a services business, if you're a software business, if you're a B2B SaaS business or enterprise tech business, really what you need capital for is increasing your technology capabilities or hosting capacities, right? That's the raw material that a lot of these businesses need, right? We'll give you examples of SaaS businesses that have, gone and cracked a contract from large enterprises and corporates, or have a subscription-driven business. But I know that my revenues will come in as a per user base over the next 10 months, 12 months, right? But I need to increase my hosting capacity and my, my infra cost today to be able to onboard that many more users, right? So I need a capital advance today just to be able to make sure that I know that I have a very clear, predictable line of revenues that is going to trickle in, right? And I think umpteen examples in both these segments that we start seeing the need for these working capital. A third very unique example is in these emerging segments of clean tech, EV, the solar or the clean tech space. You're seeing a lot of ecosystem being built around where there is charging infra, there is new technology that's coming in, and here all of this is a pay-per-use model. So there is clear pattern of future revenues. What they need is just to make sure that there is an upfront cost of that infra that needs to be paid for. And I think these are some of these very unique, different needs for capital that are evolving as businesses themselves are getting that much more asset light, right? Businesses themselves are getting that much more asset light in digital, where they're not investing in capex for the next 3-5 years. They actually just need capital to make sure that their capacities increase today so that they can continue to grow and for their future expansion.
So would you be comfortable giving us some numbers on how the performance has been?
Sure.
We believe there are two things. One is these loans are revolving. So once a business is with you, they will remain with you.
Yeah.
They wouldn't go hunt around.
Sure.
They're very happy working with you. That's what we've seen as a behavior of GEM. And many lenders have gone ahead and reported that people have taken very short tenor credit, but it's revolving in nature. Some have taken 50, 60, 70 loans over a period of 1 year.
Yeah. Agreed.
And because there is collections controlled, what is the delinquency rates that you've observed or you've had?
Yeah, so, from day zero, we truly believe we are in the business of collections, not in the business of lending. Giving money is always easier, but if you truly use technology in the new age tech that's available, that we've designed and built in-house, to be able to make sure that there's collections control from day zero, right? What we feel is you de-risk the entire business by at least 50%. 50% of your underwriting, if you have at least collections at source, whether it's dropping a virtual escrow literally in between the receivables of that business, or being able to take a direct split from either their digital sources of revenues where they are getting revenues from. And we've really battle tested this over the last 3 years, where we can, very confidently share this in public that 65% of every business that we funded is today now in round 4, round 5. While we've seen businesses that are now in round 10, round 15 of taking that short-term capital and paying this back. And I'm quoting a few of the founders and the businessmen who worked with us. They've said, every time we take a round of capital from GetVantage, we don't even know how quickly and seamlessly this is repaid, our revenue grows, and we are now ripe for a repeat round. And this leads to truly the performance. We also believe that the quality of portfolio of a business, you need to have gone through 2 cycles, 3 cycles of actually seen collections history and performance. I'm very happy to share that, as a track record, we've seen, loans under distress below 0.7% on our platform. And this is truly because even if a business is not doing as well or not doing as great as its pattern, we are in line of their receivables. Every business still has some accounts receivables. And that allows us to still make sure that even though there is delay, there's still repayments happening. So unless we've done something fundamentally wrong in evaluating a business for a short 3-6 months of its survivability, and there will be always some risk that we carry where, for whatever reasons, a business doesn't do well and shuts down. But we've also still seen that there is still trickling receivables and revenues that have allowed us to get those loans repaid. So yes, sometimes there is a delay in recoveries, but very rarely do we see a complete non-starter or a complete default on the principle of a business. And I think to validate that further, the ability for any small business to really understand that this is not a long tenured bullet or balloon payment, right? It is more personalized to their cash flows coming in, so it does not pinch them, where they don't have to plan for repayments, right, as well. I think it's a win-win for both the borrower and the lender. And this has allowed us to also disrupt some of these traditional jargons in the industry. At GetVantage, we really say that there is no traditional 30, 60, 90-day DPD and NPA because it's not once a month repayment, right? We've actually built a real-time collection system and an early warning signal that I'm not waiting for a 1 month or 2 months natch bounce to really see that this business is under stress or this loan is under stress. I'm able to take more corrective action much more in real time, right? And that's what technology should be able to do. So it's time to, really relook at a lot of traditional jargons of stress loans or NPAs that we see. At the same time, this also has forced us to innovate our business and our business metrics where we don't see, what is the AUM of the business anymore. Because it's not really about how much of your capital is out there and what is your AUM, but we rather talk about what is our total disbursement and what is our total income, right? Because now what you're really building the model towards is you're deploying capital, making sure that you have a higher turnaround of recovery, and you're really going after some real-time matrix of what is that absolute income you're making as a business, right? So, in fact, if you are able to churn and rotate that same pool of capital multiple times over, keep your OPEX lower, what we've been able to say, and we are most proud about a matrix at GetVantage, is that our ROI is what we track on a quarterly basis and a monthly basis, rather than trying to say what is our AUM, right? Because if we are able to rotate that much, keep the OPEX lower, we've actually seen that we make far more absolute income, not only for ourselves as a platform, but even for all our lenders. The absolute income is much higher than this traditional tenures of reducing balance and longer tenure AUMs being out there.
We've obviously have a big bet on that, and we've published a blog around this. Obviously, you know about this, and we'd encourage a lot of other people to go through the blog on our site, OCEN.dev, on why AUM is not a metric for short-term lending, and there is to be better metrics for it. And these shorter revolving loans have a better ROI with numbers. We've published this. I don't know if you've gone through it or not, but coincidentally, we are talking the same thing.
No, absolutely. We've gone through it, and I think we can only validate and resonate with those metrics. It's a great treasury product for a large lenders and lending books. And I think we are seeing the entire, not only us, Sagar, I think we are seeing the entire ecosystem talk about this. I think to be able to not only make higher income, but be able to de-risk portfolios in this segment that is traditionally considered as higher risk, right? We're seeing that getting demystified. I think just very recently, I think we have a banker and one of the largest lenders in the country, in Mr. Uday Kotak, talking about the importance of large corporates and enterprises looking away from debt, and banks really focusing on this smaller segment of MSMEs. And if we can understand this segment better, underwrite and evaluate them better, drive better collections, there is definitely more important to reach this segment than rotating those large pools of capital only to the top tier of large corporate and enterprises.
So coming to the ecosystem,
Yeah.
I have a question for the ecosystem. Right? When I talk to people, predominantly NBFCs and the smaller NBFCs and the bigger NBFCs, everyone is worried. They ask me one question, saying that banks have an unfair advantage of lower capital, to which I have an answer. There is consensus that if you do PSL, you will get cheaper rates from your side and all of it. But
Yes.
they feel that with standardization, with interoperability, which is what you feel is an advantage, their edge will go away and they will be on the loss. They'll not be able to compete with bigger banks
Yes.
and all. What are your thoughts around this?
There's always fear with change, right? And there's always resistance. This preconceived notion of incumbents feeling that, with the networks opening up, what is the role each one plays in? Are we letting go of some of our proprietary programs, some of our proprietary business that is out there? Or three, will we be able to compete, right? But I think history is already proven. And in every segment of financial services, the fact that if we are able to introduce interoperability and we're able to introduce these open networks, it actually makes the market bigger and expands the market size. What traditionally happens is if you're all going after that same small pie, yes, then, always it's what is the cost of capital and ultimately who has the cheapest cost or cheapest rates to offer, right? But if you can really just let this network effect play out, we've seen that in every segment and sector, the market actually expands. There's a reason why MSME is still, after so many decades, in priority sector lending, because capital has still not reached this sector, even after so much that, the government, the regulator, everybody has done, right? Because that pot needs to open up. The access to that pot needs to be opened up, right? Yes, a lot of lazy lending is what we call happens, where only the top tier capital corporates and enterprises get a lot more capital because it's easier to lend to them. Or you start seeing that traditional lenders are not able to evaluate these businesses differently. And I think that's where we've seen that this ability that this is not competition, but truly can we build collaboration, right? And through the ability for platforms to really open up and better define roles in the ecosystem for every player, right? That's how we've built GetVantage, where as a platform, we work with multiple lenders, financial institutions and banks for different product types, for different risk types, for different rate and pricing wise. But what we've been able to do is now be able to have a plethora of new customer types or new borrowers for traditional lenders who want to get access to this new emerging segment but don't know how to underwrite or don't know how to collect for them, right? And if you're able to bring a new segment, I think there is just much more business out there for all of us, and it better defines a role for every player in the ecosystem. Let me draw a parallel. Why we talk about GetVantage as one of its kind first capital gateway is really to see what happened in the world of payments with payment gateways, right? Today you see that what was an industry that was again very closed, there were large issuers and issuing banks, and there were large acquirers and acquiring banks. But today that industry has far democratized itself, and you have so many different roles and players playing different roles and just making the experience that much more seamless, right? You still have the same large banks issuing credit cards or payment instruments. You have the same large banks acquiring, but then you have very specialized players who are payment gateways, payment aggregators, who are creating layers, who are making that much more seamless the transaction, right? And I think that is what's going to happen in the world of credit, truly. And it's going to only expand, right? 8-10 years ago, if we spoke about how much digital payments in a cash economy like India, right? To now what we are seeing already has happened in the payments world, I think that's exactly what we're going to foresee in the world of credit, is this network effect, is this interoperability is going to only expand the market 10, 20 times more. And that means there's just so much more for everybody to grow, as long as each one has a very clear defined role and is handling that piece of the leg and each one makes money in that value chain.
A lot of people want to get onto the bandwagon of MSME lending. You've not had any baggage, you've not had any correction to do, you've not had any transition to do, you started fresh up with MSME lending. A lot of lenders want to move towards cash flow lending, MSME lending. What do you think is a good approach for someone who wants to get started or do this? And I'm talking in variety of lenses because you do a variety of roles. As a LSP moving to more of a borrower agent, doing that role better. B, as a lender, either doing my underwriting or thinking about this business, right from every aspect. I'd not limit you to a particular bucket, but what do you think is a good getting started or a working model that has worked for you that you would want to share?
I think the key word here is collaboration. I think for every player, whether it's an incumbent or a new age player, I think the belief and the importance that in financial services and especially in credit, the opportunity is very large. The TAM, the target market size, is very large. And I think starting from a point of being open to collaborating across various aspects, right? And that starts also from every player reflecting inwards and seeing what is their core strength in, right? Some have very strong balance sheet strength, and I think they can absolutely believe and assume the role of being a lender. Some have the ability to being able to have access to borrowers and can have the role of playing, a borrower agent role. Some have access to being able to understand the entire business process of lending, right? And I think it's each one understanding what their core strength internally is, and then being very open to collaborating. I call it a collaborative competition, right? Yes, in fact, in our journey, we work with about 8-10 leading lenders in our journey. And yes, in some cases, we are competing. In some cases, there is only collaboration because the market segment, the customer types are very, very unique and different in every sector. The ability to personalize product types, the ability to personalize programs for every segment. And I think that rounds off with ultimately being able to truly play out that if we all understand our core strengths and if we are able to drive collaboration, what technology and what we've been able to do as a platform from day zero is to also truly make co-lending or co-investing a very, very real-time phenomenon, and allowing technology to make that happen more real-time in a more frictionless manner than in a traditional manner. And that allows risk to also be well distributed on various lenders' books rather than one lending book carrying a very large risk of one sector or of one business type, right? And I think what we very, very quickly forget in the space is that if the market continues to grow and this network effect increases, it's not competition, but if I'm participating as a co-lender in many programs and being able to participate in many product types, I have a much more diversified portfolio, I have a much more diversified book, and that in itself de-risks, right? And to look that this is going to be the future of what we strongly believe, the future of debt, credit, and venture capital in India is going to be, is usage of the same underwriting, the same digital collections mechanism for all forms of long-term capital, short-term capital, and in some cases, even equity capital that businesses are going to raise. One single data-driven underwriting and collections.
Bold statement. I'll conclude with a question. If you were granted a wish on MSME lending side, what would that wish be and why?
Oh, well, a lot of wishes, as a founder.
That one wish.
Yeah, you have to always be...
Don't be greedy, that one wish.
You're always opportunistic and greedy to take platforms like this and talk about everything. But I think we've already seen tremendous amount of signs of improvement across every player in the ecosystem. For an inflection point truly happen, and that inflection point on credit is just around the corner. We strongly believe that, which means that public players, public infra, private players, industry players, the regulator, and the government are all very focused on making this happen. There's great forward strides on the regulatory aspect. There is great strides where digital lending guidelines that the regulators rolled out. Of course, we'll always want for more improvements and additions in that. I'll leave you with only two wishes. The one wish is that absolutely, I think the ecosystem needs to start looking at personal lending, very different from business lending, and which means that the way we underwrite, the way technology is used, the way the regulators view these has to be looked at very differently. And I think that's one key trigger that, if accelerated, we'll be able to achieve this potential that much more. And the last one is the openness for every industry player to want to collaborate rather than trying to do it themselves. I think it's time that, whether you're a large marketplace or a platform, or whether you are a traditional lender, right? For everybody to make sure that we'll make this happen in a more network and collaborative fashion, rather than worrying about controlling. As a lender, I want to control my anchor programs that I have access to, or as a platform thinking as saying, oh, it's just credit, I'll make lending happen and go live. I think, again, to leave everybody with saying, lending or financing is not a feature, but it's a business by itself. And I think it needs a specialized role played by a lot of players to really make the end-to-end cycle happen. So the one wish is we see a lot more collaboration really spring off in this industry and in this ecosystem.
Thank you, Bhavik. It was an amazing conversation, very insightful for me as well. Some of the theories that we've been believing are being applied by you, so it obviously feels great to see things in action. May you get your wishes.
Thank you. We build this together.